Stock Daily Insights. Your daily market compass.
Today, we're going to dive into two main topics. First, we'll break down an article published by Nick early Monday morning and explore whether he gave any hints about whether the Fed will cut rates by 25 or 50 basis points on Wednesday. The second topic, one I've spent a lot of time preparing, is about the yen carry trade and whether the unwinding of those positions has truly ended. Without further ado, let's get right into it. Let's start by looking at today's asset price movements. The US dollar index dipped slightly, and US Treasury yields also dropped, with the 2-year and 10-year yields both falling by 3 basis points. Meanwhile, TLT, the long-term bond ETF, rebounded by 0.9%. Overall, the market was relatively calm today, with the major indices showing mixed results. The Nasdaq fell 0.5%, with a sharper drop at the open, led by declines in the tech and semiconductor sectors. In a previous video, a viewer commented, "Could it be that we're not trading a recession, but instead seeing sector rotation?" I've thought about this, and I don't fully agree with that view. Why? Because during this period, not all sectors have been moving in sync with the S&P 500. I've picked out 4 key stocks here: Home Depot, DHI, Zillow, and IYR. I've aligned their performance with the S&P 500, starting from July the 16th, the last time the S&P 500 hit a new high. From that point until now, the S&P 500 has only fallen slightly, now just 0.6% below its previous peak. So, over the past 2 months, the S&P has been in a holding pattern. However, when we look at these real estate-related stocks, they've all seen various degrees of gains. For example, IYR is a REIT ETF, Home Depot is tied to housing-related industries, DHI is a home builder, and Zillow is an online real estate platform. Real estate stocks are primarily driven by profitability, and secondarily by the economic cycle. If the market truly believed we were trading a recession, or that recession risks were rising, real estate stocks shouldn't be climbing, even with potential profit declines. From this perspective, since August, we can't strictly define the market as trading on a recession narrative. There has been clear sector rotation. Now, let's talk about the article published by Nick on Monday morning, Eastern Time. What's interesting is that this article wasn't shared on his X account, formerly Twitter, but it's quite detailed. Let's first look at the subheading of the article. The Fed usually prefers to move in 25 basis point increments when hiking or cutting rates, but this time the situation is more complex. At first glance, this statement seems neutral, but if the intention was to adjust market expectations, Nick could have just mentioned the first part of the sentence, "The Fed usually prefers 25 basis point moves," and left out the "this time is more complex" part. Just by stating the first half, the market would have quickly adjusted its predictions accordingly. Let's dive into the body of the article. The first line says, "The core objective of this Fed meeting is to maintain or ensure a strong labor market." Following that, Nick quotes a former Fed advisor, Brian English, someone we don't often hear from. English states that a few weeks ago, he thought a 25 basis point cut made more sense, but with the recent slowdown in the labor market, he's more worried. Even after 2 or 3 rate cuts, English believes the overnight rate will still remain relatively high. As the article continues, Nick introduces the concept of regret management. He quotes former Fed official Robert Perley, who says, "If I were still at the Fed, I'd feel comfortable cutting by 25 basis points, but I'd lean towards 50. Perley continues, saying that even if the Fed cuts by 50 basis points, and the economy doesn't deteriorate, the Fed won't regret it because the overnight rate would still be high. This article was published early Monday, and since then, we've seen a shift in market expectations. On Friday, the probability of a 50 basis point rate cut stood at 50%, but as of today's close, after the Asian markets opened, the probability has risen to 74%. To be honest, this article doesn't make me 100% confident that the Fed will definitely cut by 50 basis points, but it does lean in that direction. One thing to emphasize is that this isn't my personal prediction, it's what the market is currently pricing in. Historically, as we approach a Fed meeting, the market tends to accurately predict the Fed's moves. If the market guesses wrong, the Fed's decision could trigger unnecessary volatility. So, the closer we get to the meeting, the more closely aligned the futures markets guesses are with the actual outcome. Before diving into the yen carry trade discussion, let's touch on some news about Amazon. Today, I saw that Amazon's CEO, Andy Jassy, announced plans to streamline the workforce, and he's requiring employees to return to the office 5 days a week, ending remote work. Amazon has always been one of the more intense workplaces among tech companies, and now it seems like they're doubling down on that. Andy also stated that he wants Amazon to operate like the world's largest startup, which from an investor's perspective, is a great move. This signals that they're focused on improving internal operational efficiency. About a year and a half ago, Andy mentioned that Amazon's e-commerce profit margins could return to pre-pandemic levels, and over the past few quarters, we've seen steady improvement in those margins. Their operating margin has grown from 1.83% in Q4 2022 to 9.92% in Q2 2024. Today's decision by Andy reinforces that there's still room for further improvements in Amazon's efficiency. This highlights an important point. When you invest in individual companies, once you understand the business, management, and future outlook, macro factors like whether the Fed cuts by 25 or 50 basis points, or even potential recessions, have little impact on long-term investments in companies like Amazon. I've said this before, each investor needs to find their own focus. For me, company fundamentals always outweigh macroeconomic movements. Now, let's move on to the concept of the yen carry trade. In simple terms, carry trade involves borrowing yen, a low-interest rate currency, to invest in higher-yielding foreign assets. If there's no leverage through borrowing yen to make these investments, it's not considered a carry trade. For instance, Japan's pension fund allocates 25% of its investments to foreign stocks, and another 25% to foreign bonds. But since there's no leverage involved, this isn't a carry trade, and there's no unwinding risk. One common misconception is that you can gauge carry trade exposure based on Japanese individuals or companies holding foreign assets, but that's not accurate. The real risk lies with leveraged investments, typically by institutions using yen to fund other asset purchases. According to a BIS report, most of the carry trade unwinding occurred between July and early August. I mentioned this in a video a few days ago. The market narrative began shifting during that period. The BIS report confirms this, showing that the timing of the carry trade unwinding matches this shift. Mainstream media often attributes carry trade unwinding to Japanese investors, but the BIS report suggests that hedge funds were likely the main players in this unwinding. Hedge funds have been increasingly sensitive to carry trade returns since 2022, and their positions became crowded and highly leveraged, especially multi-strategy funds, where leverage can reach 4x or even 14x. The CPI data released in July triggered a drop in the dollar index and U.S. Treasury yields, which prompted these hedge funds to unwind their carry trades. The unwinding of the carry trade didn't just impact U.S. Treasuries and equities, it also affected emerging markets. The essence of a carry trade is borrowing low-interest currencies like the yen to invest in higher-yield assets, such as Mexican bonds. When carry trades unwind, it causes the currency of those higher-yielding assets, like the Mexican peso, to depreciate. In fact, this recent carry trade unwinding had a larger impact on the peso than the Fed's 2022 rate hikes did. If carry trades reemerge, we could see similar effects, with potential consequences for emerging markets. CFTC data shows that, since July, short positions in yen futures have completely disappeared, and now the market is net long on the yen. However, the currency swap and forward contract markets are much larger and more difficult to measure. Between the end of 2021 and the first quarter of 2024, this part of the market grew by about $435 billion. BIS's conclusion is that, while the market volatility in August was brief, carry trade positions had accumulated over a long period, meaning that the unwinding we saw may have only been partial. This suggests that we shouldn't be rushing to short U.S. stocks based on this report. However, it's important to keep an eye on this situation. If future Fed rate cuts, or a Bank of Japan rate hike triggers further market declines, the unwinding of carry trade positions could amplify volatility in the market. In summary, today we covered two major topics. First, we analyzed Nick's article and how the market is interpreting the Fed's potential rate cut on Wednesday. While there's still uncertainty, the market is leaning towards a 50 basis point cut. Second, we explored the yen carry trade and its recent unwinding. Hedge funds played a significant role, and while we've seen some unwinding, there could be more volatility ahead, particularly if the Fed's decision or the Bank of Japan's policies shift in the near future. Understanding these broader market mechanics is crucial, but at the end of the day, when investing in specific stocks like Amazon, company fundamentals take precedence over macroeconomic noise. As always, it's important to stay informed, patient, and ready to adjust as new information becomes available. Thank you for watching today's market update. For more insights and daily stock market analysis, don't forget to subscribe to our channel and turn on notifications. Share this video with others who might find it helpful, and leave your thoughts or questions in the comments below. See you in the next update.